UK inflation just fell sharply and markets reacted instantly. Bond yields dropped, rate cut expectations jumped, and suddenly a big question returned. Are global rate cuts finally coming? Or is the market celebrating too early? Today I will explain what actually caused this inflation drop, why markets reacted so fast, and what this really means going forward. So, inflation is not just another data point. It controls the interest rate, loan cost, housing affordability, stock valuations, and government budget. That is why markets don't wait for central banks. They react immediately when the inflation surprises. And this time, the surprise was significant. So, what actually happened in the UK? UK inflation fell more than expected, not because the economy suddenly collapsed, but because several pressures eased at the same time. Energy prices cooled, supply chains normalized, food inflation slowed, and earlier interest rate hikes finally started showing impact. On the surface, this looks like a clean success story, but markets never stop at the surface. So, inflation can fall for two very different reasons. One, because policy worked smoothly. Secondly, because economic growth is slowing faster than expected. Both look identical in data, but they can lead to completely different outcomes. That is why bond markets reacted first. Now, when the bond yields fall sharply, they are not celebrating, they are preparing. So, why are the central banks still cautious? Even after this inflation drop, central banks are not rushing to cut the rates because cutting too early risk the inflation returning, loss of credibility, and policy mistakes. Central banks prefer to stay tight slightly longer, then repeat the past stop start inflation cycles. Markets want speed, central banks want control. Now, why does this matter beyond the UK? The UK does not exist in isolation. A sharp inflation drop here sends the signal globally to Europe, to US, and to the emerging markets. Investors are now asking, is this the beginning of a global shift in monetary policy? But one country does not start a cycle, trends do. So, what does this mean for investors? This phase is dangerous for investors. Hope driven rallies can reverse quickly, but genuine cycles begin quietly. The smarter approach now is watch the inflation trends, not one off prints, and watch the bond markets, not the headlines, and focus on strong balance sheets and pricing power. Rate cuts will come. Markets just tend to misjudge the timings. So, what happens next? In the short term, markets will remain sensitive to every inflation release. In the medium term, growth data will matter more than inflation. In the long term, rate cuts are inevitable, but only once central banks are confident inflation is truly under control. The biggest mistake investors make is confusing relief with recovery. So, if you want calm, clear explanations of macro trends without hype or panic, subscribe. And if you want to understand how oil prices and currencies shape inflation before central banks act, watch this next. Thank you.